now, and we're ready to go.
Okay. Thank you, everyone. It's good to see everyone. Some of you I have seen extraordinarily recently. Some of you I haven't seen in a little while. So thank you all for coming. This is a good-sized group and not a huge surprise considering what's going on, which is why we're here in the first place. So we're gonna talk about a number of things today, but clearly the genesis of this meeting was really just all of the questions that have been coming into the office, with everything bouncing around. Anytime there's a lot of volatility, it creates these questions. And volatility is always a wonderful word. I've said this before. Many of you have probably heard me say this before, that the word volatility is a word that everyone in our industry has co-opted to prevent from having to say drops. So let's just say drops. Markets have pulled back a little bit. We all know this, and there's a lot going on. So we felt that it was a good time to put another one of these things together, just to address some common questions. So a couple of just quick housekeeping things. Besides the fact that my internet doesn't seem to be behaving real well, and I hope it stays on. If you have questions, as Jason said, you can unmute yourself and ask those questions. You can also write those questions in through the chat feature. Those will go to Jason now. And we will have, but we'll have some time, I believe, at the end to answer questions directly. But if you have them along the way, feel free to hop in. Okay. So with that, I'm gonna share my screen. We'll do a drum roll and we'll see if it works. But so far so good. So here we go. Okay. Can everybody see this? Does it look correct, Jason?
Yes, it does, sir.
Okay. So here we go. What's going on? No real big surprises here. I don't think that there's anything on this page that is going to be terribly shocking to anybody. But I thought the best way to get started was to just do a little bit of a review of what we've been going through this year. And if you think all the way back to January, it feels like, in market terms, it feels like another lifetime ago. But if you think all the way back to January, we were talking about a little bit of inflation. We were talking about there were some pullbacks that were primarily happening in a lot of the tech names, the big tech names that had done so well in 2020 and 2021. And we were having very quaint conversations about interest rate increases. We were talking about things like, well, maybe we'll see 3 or 4 or maybe even 5 interest rate increases through the year, just to kind of keep things under control. And those interest rate increases were expected to be a quarter point each. And the market pulled back a little bit, not a huge surprise, because it had perhaps gotten a little bit ahead of itself at the end of last year. And then what happened was Russia walked across the border of Ukraine, and a few things went a bit sideways, primarily energy markets. And when we're talking about Russia, from an economic standpoint, that's what we're talking about is energy, right? The Russian economy, the Russian stock market, all of those things are really not significant players on the global stage, but it matters tremendously for energy prices. Also, with Ukraine, there is a lot of impact in food prices because Ukraine is a huge supplier of wheat in that area in Europe. And so food prices have started to go up. and inflation, all of these inflationary factors that were happening at the beginning of the year were pushed ahead violently by some of these things. And yes, anytime you're talking about energy prices and movements, you're talking about speculators and all of the roles that they play in there, in the volatility. But all of this stuff started happening faster and faster, all in a very compressed period of time. And there were other factors, and there are some, you can see this on some of the pictures that are here. We've been having supply chain issues. We all know this. Anybody who's tried to buy certain things or knows somebody who's trying to buy things like baby formula right now understands how some of these problems are impacting the world. We still are dealing with the coronavirus and COVID issues, and we're trying to figure out what we are looking like in a phase where things have calmed down dramatically, but are still not fixed. There are still impacts on the workforce because of it. There are still people in industries that are having trouble getting back to full speed. You're still having impacts in things like daycare, which is preventing some people from going back to work. Daycare issues just because of not enough people to staff them, and the costs are going up. We've had further supply chain issues in China. China, for those of you who may not have heard this, China has been following an extraordinarily aggressive anti-COVID policy. It's specifically called zero COVID. And what it means is that when there are the smallest detection of cases in an area, they lock down the entire area. And we all have dealt with lockdowns, right? We dealt with lockdowns in 2020. We did not deal with Chinese style lockdowns. When China says they lock down, they mean it physically. So a few cases have happened in Shanghai. They locked down millions of people overnight. And when China locks down, there are obviously far-reaching impacts on the supply chain, goods being produced. So all of these things, all of these things are negative. We know this, and none of these things are particularly fun to talk about. And again, for those of you who joined us on the last presentation we did, when we're talking about things like Ukraine, I want to say this again, that for the moment, we have to set aside the horrific humanitarian aspect of what's going on, and look at it a bit in a fairly cold way, and look at it from the economic standpoint. That is in no way to minimize what is horrific over there, but we have to look at this right now in terms of the global impact and the global economic impact specifically. So all of these factors are all interconnected, and there are others that really we haven't even listed here, but they're all inflationary in different ways. One of the other things that we haven't mentioned yet, but we're still seeing the implications of this, is the amount of money that has been created, printed, and distributed in this country over the last couple of years. You know us, we are not political here. We are not taking a political stance on this, and that is a highly political issue. And it's become rather fashionable, depending on where news source comes from, to blame these things on one factor or another. Oh, there's too much money going out and therefore it's causing inflation. Well, yes, that's an inflationary factor, but there's more than one. You cannot pull one lever in economics without affecting 5 million others. And this is a perfect example of that, okay? So what is happening? The Federal Reserve has come out and raised interest rates. Remember, as I mentioned a minute ago, at the beginning of this year, we were talking about what now seems quaint, 3, 4, maybe 5 quarter point interest rate increases. We now know we've already had we've already had the beginning of this. We've had the liftoff in rates, and we're talking about now 50 basis points or 0.5% movements that are happening and that are forecasted to happen again at the meeting in June and very likely again in July, and in quite possibly more throughout the year. That has been signaled. The Federal Reserve is aggressively moving. Some would say not aggressively enough. That remains to be seen. But the Federal Reserve is moving aggressively to tame inflation. Okay. And at the same time, they're trying to thread the needle and not slow down the economy so much that it tips into a recession or that it impacts things even more. We're going to talk about the recession in just a minute. The potential, let me say that better. We're going to talk about the potential for recession. There is no recession that has happened yet. But we're going to talk about that in just a second. So what does this all mean? And why has it impacted accounts so significantly? Okay, we're talking about recent history. We've had a lot of questions about this, particularly with the downturn that happened in the market in 2020 around the beginning of COVID. That was a short and violent drop in the markets that was actually bigger than what we have seen. Quite a bit bigger, as a matter of fact. Right now, the S&P 500, it just for a minute touched the 20% barrier. What was that, about a week and a half ago? Intraday, it was down 20% from its peak, which technically signals a bear market. Okay, but it bounced back up and it has not closed below that level, which is another thing that many people look for the true trigger of a bear market, is actually a close that is down 20% from a peak. And the market has actually rebounded a little bit. And as we were talking about earlier today, we need to do these presentations more often because the market's up 500 points as it was the last time we did one of these things. So apparently we need to do one of these every day. But that aside, what has happened, what has happened with the market has been pretty significant volatility, and it is volatility that we expect to continue. Okay, so I know we got a lot of interconnected issues, but I'm sorry, the point that I was making before was the people have asked about this downturn in comparison to the last one in 2020, which, as I said, at its worst, the S&P 500 was down almost 35%. But a lot of people didn't really see that impact in the same way in their accounts. That's partly because it happened so fast that you had to look at the accounts on a very specific day or series of days that were close together to have seen a significant impact. But the other thing that is a little bit different about the last few months versus that one is the movement of the bond market. Okay. Because of the interest rate increases and because the pace of those increases has increased, the speed at which those increases are happening has increased, and the expectation for them has increased. The bond market has been impacted significantly. Okay, now we have to remember back to our finance classes. When interest rates rise, bond prices fall, and vice versa. Okay, what we have been dealing with for the better part of the last 10 or 15 years is declining interest. Really, the past 40 years is declining interest rates. From the peaks that were hit in the late 70s and early 80s, rates have been generally declining all the way until they were sitting at zero for however many years, until the very recent past. That has been very positive for bond prices. Okay, I can explain why that exists in great detail. It's a little bit outside the scope of today. I don't want to take too much time on that, but if you want a more detailed explanation about that, just contact us and we'll talk about it. But just remember that bond prices and interest rates tend to move in the opposite direction. Okay, so what we have seen in the past couple of months is bond prices fall as the expectation of interest rates have been rising. Okay, now what that means is that while bond prices have been falling, stock prices have been falling at the same time. That's different than what happened in 2020. Okay, when stock prices fell in 2020, bond prices, because people were scared of the stock market, they were going and buying bonds. Well, what causes any price to go up? More buying pressure, right? And that's exactly what happened. You may remember the term flight to quality. That's what was happening back in 2020. Everybody was scared about this new COVID thing. We didn't know what was going to happen. People were talking about the next Great Depression in the economy, and we all know what happened. There was technically a recession for a very, very short time, but then everything took off, and we left that in the dust very quickly. Okay, so that's been the biggest difference about this most recent downturn. And this does happen periodically in investments, but you have bonds and stocks pulling back at the same time for some of the same reasons. Okay, now the interesting thing about bond prices and interest rates is, like anything, the bond prices are affected not just by interest rates, but by a lot of factors, buying and selling most directly, right? So what's interesting about bond prices, and what we believe is happening, or maybe already has happened, we may be able to use the past tense here, is that bond prices have basically been reset based on where the market has essentially assumed / decided interest rates are going to settle out, maybe sometime later this year, or maybe the beginning of next year. Okay, now interest rates will continue to increase. You will still hear things about the Fed raising interest rates. The Fed is raising certain kinds of interest rates, very, very short-term interest rates that really don't directly impact much of what you and I do on a day-to-day basis. But a lot of things are tied to those interest rates. So when the Fed nudges things up, it washes its way through the economy. But when you look at bond prices and the main rates of interest, or main interest rates that affect these bond prices, they've really already moved significantly towards where we think the world thinks interest rates are going to settle out. Okay, so the good news on that front is that it is very likely, we believe, that the vast majority of the damage in the bond market has been done. And it's possible that if the economy does start to slow down a bit, or perhaps we do tip into a recession, what might happen is the expectation of those interest rates might come back a little bit, or nobody's talking about this right now, or the Fed may have to step back in at some point if they overcook things and cut interest rates. Okay, and if that were to happen, that would theoretically be positive for bond prices. Okay, so these things are all happening at the same time that we are having the hits to the stock market that we all know. But we have to remember that there is some underlying strength here. It's not getting a lot of press, but there's some underlying strength in the economy that we don't want to forget. And we want to talk about recessions and the market movements around recessions. Okay. First thing is I want to talk about, before I get to recessions, let me say one more thing. I want to just kind of take a quick look at this chart. What this chart shows is not about recessions. This is about stock and bond performance after interest rates start to rise in a prolonged way. So we've had 4 sessions of this in the last few decades: 1994, 99, 2004, and 2016. When interest rates have started to rise after a prolonged period of either stability or declines, in the first 3 months, as you can see, most investments have had losses. But look what's happened after 6 months after that rate hike cycle has started, and 12 months. Everything has been positive on average, some by double digits. Okay, so there's a lot of reasons to believe that. So let's talk about recessions, right? Everybody is asking this question. It's a big, scary word. Let's talk about it. First thing to remember about recessions is that they are not a subjective measurement of the economy. They're fairly rigid. Now, there's no one universal definition of a recession, but the most common one is 2 consecutive quarters of negative economic growth. Okay, so drops in the economy, drops in GDP that persist for more than one quarter. Okay, now you got to remember one thing about recessions and stock markets. Okay, and investment markets in general, but especially the stock market. The stock market is what is known as a leading indicator. The stock market is not the economy. The stock market is a reflection of sentiment and where the world thinks things are going. Okay, if you look at our economy right now in a vacuum, it's actually pretty good. And ironically, that's what's allowing, in many ways, it's what's allowing the Fed to increase rates, because consumer demand is still extremely high. People, I know it doesn't feel like it, but people still have a lot of money for different reasons. A lot of it has been saved up over the pandemic. There's still a lot of economic activity and people are still buying stuff. Okay. People are complaining about gas prices, but people are still buying gas. There really hasn't been any impact on demand. Demand is still there. What's not there in many of these areas, especially with certain kinds of goods, what's not there is supply. Okay, so in a vacuum, the economy is doing pretty well. Unemployment is fantastic, historically strong. There's more to that story, of course. Right now, there's not enough people to fill those jobs, but unemployment is doing historically well. But why is the market pulling back? It's because the market is looking forward and it's looking to see what impacts or what are the likely impacts of all of these things, especially inflation, on economic growth, on future activity. Is there going to be a slowdown? Okay, and that's why, and the markets are pretty sensitive to this right now, which is why companies like Target last week, I don't know if anybody saw this one, but Target reported that they had a little bit of a slowdown, or there were some numbers that were reported that indicated there might be a little bit of a slowdown in spending, and Target stock dropped 30% in a day. Okay, is the value of Target Corporation 30% less than it was yesterday? Probably not. But that's what happens when you get sensitive times, when people are really hyper aware of these things and markets are kind of on edge. Okay. But the thing about recessions is that recessions tend to be what's called a lagging indicator. You don't typically see these measurable things in the economy until the problems are very well established. Okay. So historically, and I'm going to show you something in a minute that talks about this a little bit, but equity markets, again, investment markets in general, but especially stock markets, tend to do really badly expecting a recession, but actually during the recession, they don't tend to do all that bad. As a matter of fact, going back through the last, I believe, 13 recessions, there have been more times that during the actual months of recession, stock markets have actually increased. And when they have decreased, it's actually been pretty muted, right? Most of the impact is before. Okay? But by the time you're in a recession, most people and the markets tend to be looking forward to the next step as to when things are going to get better. Okay, so I know it's not the most reassuring thing, and I know that there's concern out there, and it's not a real comfortable feeling when we're going through these things. But a lot of what's happening right now is pricing in the possibility of a recession. Will we have a recession? We don't really know. Certainly the odds have gone up, But from an investment market side, this might sound a little crazy on the surface, but from an investment market side, it might not matter all that much. Okay, we know things are probably going to slow down a little bit. Whether it technically tips into a recession, maybe, maybe not. But if we're looking at it in the context of investment market performance, a lot of that is probably already priced in. Okay, so we know that there's a lot of ugliness out there, but what can that mean? All right, here, the chart that you see in front of you is talking about what happens to markets after interest rate increases. Well, let's talk about what happens about recessions. Okay, now this one, it goes back to 1948. Okay, the purple line on the bottom shows the peak, or I should say the trough, excuse me, the low point in the market pullback during and before and during these recessions. But then the two bars next to it are where the S&P 500 was 1 year after the trough and 2 years after the trough. And if you look all the way to the right, before the average and the median, you'll see 2020, right? 34% drop. 1 year later, the market was up 75%, and 2 years later, it had doubled. Okay, we all saw this. So these are great things, but I'm sure what you're sitting there thinking is, okay, Mike, that's fantastic. Where's the trough? And unfortunately, you never know for sure until you can look at it in the rearview mirror, right? But if you look at the average and the median, we're not all that far off right now. Maybe there's a little bit more to come if we were to hit these averages. But a lot of this damage very likely has been done short of something really unexpected happening. And if you look back on this chart over other times, there were quite a few times where the trough was 15, 14, 21, 17%. Yes, there were some big ones, okay? And 2008 is the one that's fresh, the worst one that's still fresh in everyone's mind to a degree. That one was ugly, okay? But you gotta remember, there were a lot of structural factors in 2008 that we really don't believe are out there. That was years and years of speculation, primarily in the real estate market, that was drastically overblown, leverage upon leverage upon leverage. And when the music stopped, there weren't enough chairs to go around, and it almost brought down the entire global financial system. There's a lot of ugly things happening right now. And yes, there have been a lot of increases in real estate. There's questions about a bubble there. We don't believe that is the case. We believe the pace of those increases will come down. And I would say that is probably maybe the primary target in many ways of what the Fed is doing. But the difference about the run-up in prices in real estate over the last few years versus what happened in 04, 05, 06, 07, 08 is that in those times earlier, that was done, a lot of that was done with just speculation. It was borrowing on top of borrowing on top of other borrowing on top, supported by inflated asset prices. We don't see that froth in the economy right now or in the real estate market because a lot of it has been, yes, you could call it speculation, but a lot of it's cash. You know, how many people have either tried to buy a house or know somebody who's tried to buy a house in the last couple of years? And what does everybody say? We bid 5%, 10% over asking, and we got trumped by an all cash offer at 15, right? So yes, that's speculation, but speculating with cash is totally different than speculating with air like it was 10, 15 years ago. Okay, not 10, a little bit further. So there's a lot of things out there and that where we don't see the same kind of fundamental weakness as has existed even in the 2008 timeframe. So yes, will things slow down? Probably. Should things slow down? In some areas, probably. But it doesn't automatically lead to or require some huge drop to reset everything. We think that this is a much more structural thing. We also think that the conversation about inflation is going to change in the relatively near future. Right now, the conversation is it's just increasing and increasing and increasing. But we believe that some of the pressure comes off of this. supply chains ease off a little bit. China goes back to some level of production. Perhaps there's some movement. Unfortunately, Ukraine doesn't look like it's going to be settled overnight. Theoretically, it's possible. It's probably not the most likely situation. But as some of these things start to ease off, even COVID, and perhaps a few people are able to get back to work, what we believe is that some of the pressure is going to come off. And these numbers are going to stay high. It's not going to go back to 2% overnight. But if all of a sudden they start to stabilize and the inflation reports that come out every month start to be the same number, or they start to maybe pull back by 0.1% here or there, the conversation is going to change. And all of a sudden, it's not going to be, oh, runaway inflation. It's going to be, well, is inflation kind of peaking? And don't forget, inflation can be a self-fulfilling prophecy. The more people talk about it, the more it can happen and the more it's expected. But eventually, even through some altered consumer behaviors, and if people start maybe take their foot off the gas on some of these purchases, all of these things, we believe, will start to ease that pressure a little bit. And there's one thing we haven't talked about yet in the middle of May. And there is, you're going to see some of my cynical nature coming out here for just a split second. Don't forget what we have coming in November of this year. Okay, we have election season happening again. So do you think that there may be some reasons to kind of get some of this thing out on the table so that perhaps some of this may look a little bit better towards the end of the year? We can get into conspiracy theories around that all we want. I won't go down that road, but there are a lot of people up for re-election that would probably prefer to not talk about runaway inflation, except in the context of blaming the other side for it. Right? So elections are going to change this, change the outlook of the world here too. So time will tell on some of these things, but there's a lot of different things out there. I talked about some of the issues that we've had with the traditionally conservative things. A lot of the things that we are doing at StraightLine, depending on the type of account that you have seen some of these already. We've made some additional changes within the last couple of weeks. And because diversification, diversification, the traditional sense of it, stocks, bonds, cash, we have known for a while, you got to have additional things. Yes, we do have some exposure to bonds. We have had some exposure to bonds. But the more comprehensive that can become, the better that diversification, the better the chances are that diversification can do its job over time. Okay, so it may be a higher percentage to commodities or to natural resources, or who knows, even to precious metals. We haven't been doing that lately, but this is just some of the things that we're thinking about. Okay, and some of them that have already started to be implemented. And so there is one message, and then I'm going to shut up for a minute, but there's one message. And again, I don't care where you get your news from. I don't care if it's far left or far right or somewhere seemingly in the middle. Be very cautious about where that information is coming from. Our news system is based on ratings, and nothing sells, nothing holds ratings better than outrage. Our news in this country, and around the world to a degree, but especially in this country, have become masters at selling outrage. And again, I don't care if it's left or right, we can bring everybody into the same pot. But these things exist to get people fired up, because the eyeballs get glued to the screen. So many of you have heard me say this before, but let's all agree on one thing today, if nothing else, and that is, let's make a concerted effort to have those ratings go down just a little bit. Doesn't mean that you have to bury your head in the sand. It doesn't mean that you shouldn't be paying attention to any of this stuff, but be very cautious about these things, especially as we're leading into these election cycles. Because these things just get inflated constantly. Okay, so with that, I'm going to stop talking for a minute. That was a lot of words, I know. I think a question may have popped in. Before we go any farther, would anybody from StraightLine, we have a number of our folks, most of our folks are on this call. Is there anybody at StraightLine that would like to jump in, or do you want to just say, no, Mike, you talked over the whole thing again, just like we knew you would?
No, Mike, you talked over it. Just no, I'm teasing.
Yeah.
So, sorry, I'm monitoring what's coming in, so bear with me.
I'd be happy to throw in a couple of things just from some of the conversations that I've had from my clients. All of the advisors from StraightLine have been getting a lot of phone calls from folks. And a lot of it has to do with anxiety about what we normally call the headline number. And fixing on the headline number in your accounts tends to kind of obfuscate the things that are going on behind the scenes. And behind the scenes, please be reminded that all of the investments that you have that are managed by StraightLine are vetted constantly. And particularly in the STARS portfolios, the investment selections are made very carefully. Each one of the investments that you have is managed by a professional manager. Those folks in the mutual funds and the bond funds are trying to do the best they can for you. And when the market is down like this, they are continually buying investments in your name. Some of the ones that they already hold are throwing off dividends. There are companies being bought and sold. There are bonds being bought and sold. So when the headline numbers are down like they are right now, it all is not lost. There are a lot of positive things going on, and the positive things are that the folks that are managing investments that we have you in are buying things at a bargain price. And when the markets eventually do rebound, that benefits everyone. And I know a lot of the folks that are on this call are, I could accuse you of being a little bit of a finance geek because otherwise you wouldn't be here. And I also know that you talk to some of the peers and perhaps some of the younger people that surround you professionally. And if they express some anxiety about this, please remind them that, again, when the headline number is down, there are still really good things going on behind the scenes. And that will benefit them in the long run. All is not lost.
Thank you, Mike.
Might say one thing, Mike. Can you hear me?
Yep, absolutely.
Yep.
You've probably seen us talk many times, but the way we manage on an overall basis is modern portfolio theory. And the quickest explanation is if your allocation is 60-40, 60 being equities, and the market goes down 20%, the equities drop 60 times 20 will drop 12%, but it makes your equity fixed income ratio drop. So what we do then is we backfill into the equity market, taking from the bonds. It acts as a multiplier when the markets get better. It also, we did this along the way when the markets got really good, we took profit off the tables. That is the only way. I see the pictures that are on this, and there are a lot of people that maybe have been around for a little bit longer, as Mike and I have, and I have not seen in 40 years anything that would dispute the fact of the way we manage from an asset allocation standpoint. What has been getting better is our research and the way we look at certain sectors and the way we look at international and the way we look at bonds. So Mike has done a really good job of taking the research department ahead. And so we're all in good hands. And I think the future is very bright. And Mike Rice said the word bargain, but I don't think the SEC allows us to say that word, Mike. So we're going to cut that out of the recording. But either way, he's right. You buy when it's low. It's hard to do. It's scary. It's the only way to do it. Anyway, that's my comment.
Thank you, Steve. There was a question that just came in, and I want to address this real quick. It just said the one thing that I've heard driving the real estate market is corporations buying real estate for rentals or Airbnbs and buying with cash. Is this true? And with interest rates going up, will this affect these corporations investing like this? And will it help slow down the rise in availability of real estate for private individuals? It's a good question. The answer is yes, it is true. It has absolutely been happening. The one thing that I would say a little differently, will the rise in interest rates impact this? The answer I would say is not really, not for that part of it, because as you said, the corporations that have been doing this are doing it with cash. Okay, so interest rates don't really matter all that much. Unfortunately, it means that normal people competing with them, where they're typically using mortgages, many of them are going and have been fighting that battle. So will this continue? I guess it depends on, what the corporations decide. There have been a few corporations that were rather notably in that space that have backed off of that space. Zillow was one of them, and they had a huge blowback because they basically were inflating the values that they were selling, right? Because that's their business model. They've backed off of that, but there are a lot of other places, even the big investment houses that have been doing this. I think they're investing in these things for a lot of different reasons. And these corporations are going to move money where they believe investments can make them the most money. So if the pace of those increases the price increases starts to come down, it might affect the amount of purchases that these companies are making. But unfortunately, this is a reality right now. And if you're trying to buy a house, or we've heard it a lot for people whose kids are trying to buy houses for the first time, and the market is still extremely competitive about that. So no, I don't think interest rates by themselves are going to impact that right away. But it may help create an environment that is more attractive in other areas, and it might change the way that they invest their dollars eventually. Good question, though. Does anybody have any other questions? I know I have, kind of a couple other, quick thoughts, but oh, I'm sorry. I'm not sure if someone was trying to speak there. Bob, I think you may have been.
Bob, did you have a question for us? I'm going to put him back on mute for now.
Okay. Yeah, Bob, if you had a question, I'm sorry we couldn't hear you. But obviously you can feel free to call us anytime. Does anybody else, you can unmute yourself and just ask away, or again, feel free to load it in the chat here. Don't think there's anything else. And if that's the case, let me just say one last thing, and that is during these times, anytime you're looking at your account and you see red numbers, it's not a fun thing to see. And we certainly understand the concern that people have. We understand the nerves that people have. It would be unusual if you didn't have some level of concern about this, especially if you are in retirement or getting very close to needing this money to produce income for you, which I know many of the folks that are on this call are in that position. So these kinds of concerns are very normal and very common. But what we want you to remember is you got to be very careful about letting these concerns influence your decisions, influence your plan, and influence the way that you and we have worked to set these things up for you for the long term, for the years and decades to come. Okay, so we don't know if we've hit the proverbial bottom here on February 26th at 4:54 p.m. Eastern time. We don't know that for sure. We believe that a lot of that damage has been done, and we believe there's a lot of reasons for optimism that aren't getting quite the amount of press time as the reasons for pessimism. But we believe that there's a lot of reasons to feel that way. Okay, so anytime you have questions, anytime you have concerns, please reach out to us. We will continue to do these sessions, particularly when there are things going on that are causing a lot of the same questions. That's when we'll pop on and do this. But ultimately, we will be consistent in the way that we are approaching these things, and we will continue to use the process that with us. On one other quick note, stay tuned for a few other things. We're doing some things behind the scenes that we're excited to share with you here in the weeks and months to come. You're going to see a brand new website from StraightLine in the very near future. We're going to have some new capabilities on that website. We are going to be even posting videos like this in a slightly different way. So stay tuned for all of these things. We got a lot of fun stuff coming. And we, as always, appreciate your trust and your just your approach with all of these things and us. And if you have anything in the meantime, please don't hesitate to reach out. Okay.
Thank you all.
Yes.
All I want to say is it's so much fun to see so many of you online today, to see some of your faces, to see your names. It's wonderful to connect in this wonderfully technologically savvy way. Mike, your internet held up just fine, which was good. But don't forget that you can call us if you have questions. I think you're all pretty good at doing that, but I just wanted to say it's really nice to see all of you today. Thanks for joining us.
Very well done.
Thank you very much.
Thank
Mike,
you.
I'm not sure.
Thank you,
that
Mike.
we-
Thank you, everybody.
Yep.
Mike,
Oh.
did you, maybe I missed it. Do you have any sense about timeline for this volatility in the market? Do you think that it's might possibly calm itself after the elections, or are you not even considering what we're looking at? As I'm dealing with relatives who are terrified in this retirement market or in their retirement age related to what's happening. I don't think I even asked you this morning when we met about whether you see when this might even out or get calmer. What can I tell them besides what you've already told us today in this call?
Well, what you can tell them is to come right to this recording and listen to the whole thing, start to finish, and that everything is going to be perfect. But
I'm taking my computer up north so that I can do just that.
No, to answer your question, Maureen, I mean, I don't think anybody could say with any certainty that, oh yeah, this will calm down and it will calm down at such and such a time or season. I don't think anybody could say that. I don't think anybody should say that. I think that I said something the last time, and again, some of you were on that call, but I said something the last time we did one of these Zooms, and that is the market can handle a lot of bad news. What the market doesn't like is unexpected news. Okay. Ukraine is horrific. Okay. And no one knows that more than you, Maureen, right? You've dealt with that more than anybody here by multiple, by orders of magnitude. But I hate to say it in a way, but it's becoming less of a driving factor. It's known. Okay, we know that it's there. We know that it's going to cause inflation. We know that energy markets are impacted. We know that agricultural markets are impacted. We know that fertilizer markets are impacted. All of these things are there. That's why I think I used the words a minute ago about changing narratives around inflation, right? And I think if we start to see these things just kind of level off a little bit, to say that 8.1% is a good thing. If you had said that 6 or 8 months ago, it would have sounded absolutely insane. But right now, that's a perfect example of a changing narrative. We know that it's too high in the long term, but if it starts to level out a little bit, that becomes kind of normal-ish, right? So as these things become less of a shock, we expect the volatility to kind of tip back down. When that's going to happen, I don't know. I think we're close to it, but it could prove to be months. It could prove to be much longer. And there's always the question of, well, is there something out there that's going to happen that's going to disrupt things again? It's always a possibility, right? We all know that. In a post 9/11 world, especially, we know that. Right. So it's not really an answer, I don't think, Maureen, directly, other than to say we can't say for sure, but we believe that we're approaching it.
Okay, excellent. Well, my frame of reference always is coming of age in the 70s when my first mortgage was at a 16% interest rate. So
right.
Everything else looks great to me.
You're right. And that is something that's something that we talk about a lot. There are people, there's a whole generation of people that this might sound a little get off my lawn-ish, by the way, before I say this out loud. But there's an entire generation of people and of homeowners that don't know what it's like to have mortgage rates above 5.5%.
I know.
People who have owned homes for 10, 15 years. And that's going to take some time, like you said, Maureen, there's a whole bunch of other people who remember 16 or 17%, and all of the rates that went with it, right? And all rates have come down except for credit cards, of course. They never came down from the late 70s. It sounds like a broken record here, but that's another example of what becomes normal, right? And how long it takes to kind of be absorbed as normal. So yeah, some of it's just perception and the way that people deal with it.
Well, I'm using this as my teaching tool this weekend, as I'm going to have a glass of wine on my deck and send them into the house and watch your video.
Sounds
thank
fantastic.
You.
That sounds good.
Timing was great.
Is the wine the better part or the video the better part? Don't answer that. I already know the answer.
Oh, no. The video, of course, is the better part.
Sure.
Yeah, okay. So, don't ask me again.
I knew the answer before I asked the question. It's okay.
I'm sure you did. But thank you very much. I appreciate that. Because I think I did forget to ask you that. I kind of expected the answer that you gave, but I thought, well, I could be wrong. You might have more precise information about that.
I would love to give you a date. I really would. But unfortunately, I don't think we can do that realistically.
Yeah.
Does anybody else have any other questions? Okay.
Looks like the chat's clear.
All right. Thank you, everyone, again. For those of you at StraightLine that were expecting to talk, I'm sorry, I talked over you again. But for everyone else, thank you for joining us. And please call us if you have any other questions.
Hey, Mike, I have a question.
Sure.
So I just logged on because my meeting request said 4. I'm guessing I had a different time zone issue. Is this presentation available recorded somehow?
Yes,
It will be.
yes, it is. The recording is actually still going, and it will. We will get this reposted in probably by tomorrow.
Okay, thank you. Sorry.
Okay. No problem. Thank you. Thanks for coming in. But yeah, we'll get it back out to everybody.
Thank you.
Thanks, everyone.
Thank you.